Update your will. Everyone should have a will. Maybe you think that because you're healthy there's no rush. But for the sake of your family and friends, it's better to be safe than sorry. Let's have a look at just how simple making a will can be. First, you need to decide on an executor. An executor files your will with the court upon your death. An executor can be a trusted friend, family member, or a professional trustee. Next, if you have children under the age of 18, you will also have to name a legal guardian. Remember, you'll need to discuss this with your potential choice and include a possible backup just in case. You will also need to make an inventory of all your assets and name your beneficiaries. This also applies with the beneficiary designations on super accounts and life insurance policies. It's best to keep the beneficiary designations on these accounts and your will in sync to avoid any confusion. A complete list of accounts will also make life easier for your family. List bank accounts, investments, super and insurance. Ongoing. You will have to periodically review and update your will. You would need to make changes if, for example, an heir or guardian passed away, a birth, wedding, or a divorce in the family. You may also need to update parts of your will if future tax laws change. And finally, make sure you tell someone where your will is. If your will is lost, it may be assumed that you didn't have one. If you die without a will, your assets will be distributed in accordance with the law. This varies depending on the state or territory you live in. If you're ready to get your will sorted, remember, we're here to help. Please feel free to contact us for further advice. Understand your super. The goal of superannuation is to accumulate money to provide you with an income in retirement. To achieve this, your super fund will normally invest in a wide range of assets. Due to the long-term nature of the investment, this will usually include shares, property, bonds, cash and other types of assets. These will be both Australian and international assets in order to provide further diversification. This is your retirement income, so it's essential you take an interest in your super fund and its investment options, particularly when there is so much choice. Some important points to consider. Remember that superannuation is not an investment in itself, it's a tax structure. The investments are held within the super fund, and the fund is taxed at concessional rates to encourage you to save for retirement. But you have the choice of how to invest. Most super funds offer a choice of investment strategies. Study the options and select the one most appropriate to your circumstances and goals. As a long-term investment, it's important to include growth-type assets, such as shares and property. Even if the short-term performance of these assets can be more volatile, they will invariably provide a better return over periods of 5 to 10 years and more. By having a diversified range of investments, you minimise the risk of poor returns from one asset class. Just because you're nearing retirement doesn't mean you should have a short-term strategy. You may well be drawing a pension from your super account for the next 20 to 30 years. Depending on how you look at it, superannuation can either be confusing or boring, but don't forget that the level of quality of life during your retirement depends on it. It's too important to ignore. Contact us if you would like to review your superannuation to ensure it's going to meet your needs. Reducing your capital gains tax liability. You may be able to save time and money on your tax with a better understanding of the capital gains tax rules. It's widely known that under the 50% rule, investors only need to include half the net capital gain on those investments held for more than a year in their assessable income. It's the treatment and offsetting of losses which confuses most people. Generally, most investors halve the capital gain and then deduct any capital loss amounts. This is incorrect. You're meant to net out any losses against the full capital gain and then apply the 50% rule. Investors can now choose the order in which they reduce their gains by applying their losses and may benefit by netting any losses against gains for which the 50% rule doesn't apply, that is, shares held less than 12 months. A hypothetical. Ben has a capital gain on some shares he sold this year. This consists of a $1,000 gain, which is eligible for the 50% rule, and a $500 gain, which is not. He also has a $700 loss to offset against these gains. Not realising that he could choose which order to reduce his gain, Ben deducts the $700 loss from the $1,000 gain and halves it, leaving him with a $500 gain. Adding the other $500 gain, he has a final capital gain of $650. That is $1,000 minus $700 divided by 2 plus $500. Gary has had the same gain and the same loss, but with guidance from his tax advisor, he decides to do things differently. He uses $500 of his $700 loss to cancel out the $500 gain ineligible for the 50% rule, and uses the remaining $200 loss to offset the $1,000 gain using the 50% rule. That is $500 minus $500 plus $1,000 minus $200 divided by 2, leaving a $400 gain. In this example, Ben is left with a $650 taxable gain and Gary with $400. If the size of the transaction is much larger, then the consequences of getting the maths right can be quite significant. These types of savings can apply to any asset class to which capital gains applies, including property. This information is provided as a guide only. Before acting on any decision with tax implications, you should seek advice from your tax advisor. Contact us. Insurance through your super. Arranging personal insurance cover through your super fund can be beneficial for a number of reasons. Premiums are deducted from your super balance, so the cost doesn't affect your day-to-day cash flow. When combined with insurance held outside of super, this may allow you to have a level of cover that would otherwise be unaffordable. Premiums can be paid with pre-tax dollars, for example, with your salary sacrifice super contributions, which can be very tax effective. Or the cost can be covered through investment earnings and employer super contributions. Some employer super funds may provide you with an automatic level of cover when joining, but we often find this is not enough for most people. This is a foundation on which to build on though. However, there are some questions you need to ask yourself and your financial advisor before considering using super to pay for your insurance, including what will be the long-term impact on your super balance? Are there any tax implications? How will any insurance benefits be paid? Who will receive the life insurance benefits and inherit your super? What happens if you have an SMSF? A financial advisor can review your overall financial situation, commitments, and lifestyle to help you decide on an adequate level of insurance cover. They can also advise you on whether to hold insurance inside super, outside super, or to hold a combination of both.